Hey girlies, welcome back to Spoiled Girls Invest podcast here on YouTube only at the moment. We're back today and we're going to be talking about some investing misconceptions that a lot of women have when it comes to investing. And some of those include thinking that investing is high risk, that it's more wise to just save your money because, nobody can just come and take what's in your savings account. You won't wake up and see half of your money gone. And I say that with air quotes because when you invest and the investment asset performs poorly, that doesn't mean that you've lost money. That just means that at that moment in time, the asset is not performing at its most optimal performance level because of some external factor. So the stock markets are volatile because, one news article, one headline, one political decision, one statement from the president can influence the markets, and it causes other people to take their money out, to sell, to buy, to do XYZ. So investing is only high risk if you act on your own impulses instead of just leaving your money there to work for you, because you understand that in the greater scheme of things, you're not losing money just because your account looks red right now. You would only lose money if you decided to sell your asset at a loss. And that goes against the core principles of investing, and something that Warren Buffett always says. He's this billionaire investor, the owner of Berkshire Hathaways. And he always says there are two rules to investing. One is to not lose money, and number two is to remember rule number one. So both rules of investing are to not lose money. So if you invest, let's say $1,000 into the stock market, and then the next day there's some bad headline about the war in this country and the price of toilet paper or whatever, and then the next day you check your account and your $1,000 is now only $700. So on the screen, it looks like you lost $300. Don't panic. You have not actually lost $300. You would only lose $300 if you went ahead and sold that stock or that investment. Then you would be at a $300 loss. But if you were just patient and you ignored the headlines, you ignored the distractions, because that's all they are. The media and the news cycle is all just a distraction to influence people and to make them act against their own wise, rational thinking. Just leave your money alone. Let it do what it's supposed to do, because that volatility is what leads to it growing in the long run. And once you master your own psychology and recognize that investing is it's more a mental game than it is a numbers game, because the people who win when it comes to investing are the people who don't act on their own fears and their own impulses. So like the people who won the most in the 2020, the pandemic and the uncertainty in the markets, there was a really big crash in March 2020 when the pandemic was first announced. A lot of people got scared. A lot of people took their money out of their investments. But guess what? Just like a couple months later, not a couple months, but like later on that same year in 2020, the market saw their highest returns. That's when like Amazon reached like $3,000 for one stock. The Tesla stock also did really well. And just there was a huge boom and a huge growth in the stock market. Obviously now things are back in the red in 2022. Well, actually 2023. But we're heading into a more negative. We're heading into a more negative area of the stock market because it was kind of such a drastic growth in 2020. But over time, things will always continue to grow and grow and grow because that's just the overall trend of the markets. So I want to show you guys this article from Fidelity that I found that also addresses more on different investing misconceptions. So let me just share my desktop. Okay, so this is an article from Fidelity. It's called 7 Investing Myths and Realities About Stocks. So we addressed the first one, how investing in the stock market, people think it's too risky. And they recommend that you can use some investment strategies such as diversification to mitigate your risk or lower the chances of experiencing risk or negative performing assets in the market. So diversification basically means kind of like the term diversity, where instead of just choosing one asset or one stock or one company, you choose a mix, a variety of different types of investments. So the easiest way to do this is with index funds, which are also known as mutual funds or ETFs. And those let you invest in multiple companies at once. And the most common one that most people like to invest in is the S&P 500 index fund. And the S&P 500 index, it tracks the top 500 performing companies in the United States. So that means, 500 companies. So that's including your Walmart, your McDonald's, Target, Google, Facebook. Think of all these really big corporations that are very successful. It tracks all 500 of them. And if any of those companies do poorly, or let's say they go bankrupt or whatever, because it's an index fund and because it's only the S&P 500, if one of those companies performs poorly, they automatically get removed from the list and they get replaced with the next company that's doing better than them. So that's why it's a really great way to mitigate your risk and also have a diverse portfolio when you invest in something like the S&P 500 index. And another thing you can do to mitigate your risk is have a time time-based strategy, which is be a long-term investor, which means that you allow your investments to stay in the market over a long period of time. Don't be the short the short-time investor who just kind of like people who use Robinhood, where it's like they buy a stock, they sell it off the same day, or they buy a stock and they wait for it to hit a certain dollar amount and they sell it within a week or a month. That's how investing can be very volatile, because you're constantly having to track the price of things in order to buy low and sell high, versus if you just take the long-term strategy, you won't have to worry about selling your investments at the perfect time, because over time, stocks and the market, the S&P 500, is always going to rise. So if you look at this graph, it shows here in 1985, the S&P 500 index was worth less than $1,000. So I don't know what this base number is here, but let's say it was like $100 or something like that. And then as you can see over time, there was all these different, crises and things that affected the economy negatively. But over time, you can see that it's been rising. It crossed the $1,000 mark around the late 90s. It crossed the $2,000 mark around 2015. And then more recently, 2020, it crossed the $3,000 mark, and it almost shot up to $5,000. But now it's back around like $4,000. So this just shows you, someone who started investing in 1985, they have not lost on any money, even though we're currently in a bear market. We're currently experiencing a loss with the S&P 500. So somebody who started investing here at this peak in 2020 or 2021, their money is currently in the negative, right? Because they invested at this top peak right here, and their money is now down here. But someone who invested in 1985, when it was right here below $1,000, even though everybody else is experiencing a loss over here in the 2022-2023 area, they're not, because they invested when the price was below $1,000. And even right now, when the price is below $4,000, that's still a gain, a benefit for them. So the price would have to go all the way back down to where it was in 1985, which is very unlikely. But it would have to go all the way back down there for the people who invested in 1985 to experience a loss from their initial investment. Of course, people in 1985, they're probably still buying shares of the S&P 500 index fund. So, if they bought anything recently in 2020, those shares are experiencing a loss, but their initial investment from 1985 is not experiencing a loss. Okay. The next myth is people think it's safer to keep money in a savings account. And that's because, when you keep money in a savings account, it's, exactly how much money you have. When you wake up tomorrow that you're going to have the same amount of money in your savings account. However, that's the issue, is you will have the same amount of money you believe, but actually you will have less money when you wake up tomorrow because of something called inflation. So over time, every single year, the price of goods, the price of living in the United States of America, and I'm sure in other countries around the world, the price is always going up. And we know this very real right now in 2023. I always see online people complaining about the price of eggs, the price of food at the grocery stores. It's all gone up dramatically. What used to cost maybe $100 to get groceries for the week, it now costs like $300, $400 to get the same amount of food for your groceries for the week. So it is not safer to keep money in a savings account, because even though you think that you have the same $100, the same $500, the same $1,000, you actually have less because your money is worth less over time. So that's why investing is really great, because you not only will be able to keep your money, you'll be able to grow your money in a way where you will beat the rate of inflation. So let's say here they give a perfect example right here. Somebody who only saves their money versus someone who invests their money. So let's say both of these people contribute $15,000 every single year. One person is contributing $15,000 to their savings account, and the other person is contributing $15,000 to their investment account. And let's say they do this for 40 years. So let's say from 20 to 60 years old, they contribute $15,000 every single year. The person who's saving, they only experience a 2% rate of return, which is actually very generous, because most savings accounts that you get at your local banks, or even the big banks like Bank of America, Chase, none of them are giving you a 2% return in your savings account. All of them are giving you like a 0.001% return. So this is actually not even really accurate, but we're just going to let Fidelity live. Compared to the investor who, let's say they get an average annual rate of return of 7%. And that's actually very low, because, just the S&P 500 is around a 10%, 12% annual rate of return, but, we're going to let Fidelity live. So the saver, they have, at the end of those 40 years, they have around $900,000, which is not bad. But the investor, they have over 3.2 million after the 40 years. And this is the same amount of money that they both contributed, $15,000 every year for 40 years. And look at that astronomical difference. And then I'm not going to go through each of these myths, because I feel like we're already getting high on the length of this video, but this is a great resource for any of you who have some of these other concerns. This one, myth number 3, is really good too. A lot of people think investing is too complicated, it's too time consuming, but again, if you just open up a brokerage account with an institution like this one, Fidelity, you can do it on your laptop. You don't have to call somebody. You don't have to call a financial advisor. You literally just follow the steps on their website, open up an account, connect your checkings account, set up a monthly deposit, and have it go to an index fund that tracks the S&P 500. And I can literally show you guys Fidelity, S&P 500 index fund. And it's this one, FXAIX. This is the name of the symbol. So in the stock market, they use these little symbols as like a short acronym for the name of the actual asset. But yeah, so So as you can see here, it has the performance. So in 1 year, it's gone down 7.71% in terms of the performance. And that's because right now our economy isn't doing too well. We're kind of in a recession. But as you can see, compared to the past 3 years, it's given people a 12.14% return. In the past 5 years, a 9.81% return. And in the past 10 years, a 12.24% return. So in the long run, it's done very well. It's just right now, it's kind of in a negative. And then you can see here, as you can see over time from 2014, that it's just grown over time. And it's here, all these details right here. See, these are things that you don't really need to know when you're first starting investing. This is great right here. It tells you the minimum to invest, $0. That doesn't really make any sense because if you have $0, it's not really doing anything for you. But yeah, all this stuff right here. See, this is what makes investing confusing, but you literally don't really need to know what any of this means. This right here is something that's good to know. The EXP means expense, and then ratio. This is telling you how much it costs for them to run this index fund, and this is a very low number, 0.015%. So that means that, let's say if you invest $100, they would only take 0.015% of your $100 to purchase and run this investment in your portfolio. And that's a very small amount. There are other investments such as mutual funds. Those are actively managed by financial advisors. And some of those mutual funds have like a 5% expense ratio, a 10% expense ratio. So they're taking 5-10% of your money and using it to pay themselves, basically. It's basically a fee to pay the financial advisors and the financial institution that you're buying your investments from. But here, the great thing about index funds is that, number one, they're stable. They're very secure, as you can see here, over 10 years. It's consistently went up. And number two, here, the expense ratio, it's a very small amount. So this really isn't going to make a difference. Okay, so just wanted to share that. But again, if you have any more concerns, you can take a look at this article. It's really good. Myth number 4 right here is also something that a lot of people have hangups about. You need a lot of money to start investing. Wrong. Platforms like Fidelity, you can literally start with however much money you want to start. You can start with literally $50, $20, $100. There's no set amount that you need to start with Fidelity. This is another one here, trying to time the market. Again, timing the market is a waste of time because look at this graph. Somebody who doesn't try to time the market ends up making more money, the 1.6 million, than other people who try to time the market, because these people ended up missing out on really good days in the market. And so they ended up making less money overall than the person who just invested and stayed invested instead of trying to sell and get out of the market before a crash. Because oftentimes when our economy is in a crash, around the crash is the best days to be in the market, because I don't know how to explain it, but if you just look at certain charts, it'll show you that just because we're in a crash, it doesn't mean that we can't have really great days in the market. So it's always good to be invested. And yeah, the other ones, number 6, I won't really cover, but number 7, men make better investors. Wrong. Women are actually better investors than men. And Fidelity did a study on their customers, and they found that the women outperformed their male counterparts by 0.4%, which isn't a grand amount, but it basically shows that there's really no difference in terms of gender, but that women investors are more likely to be successful because they tend to trade less frequently and they invest in more age-based allocation of investments. So basically women choose more stable, secure investments. And also women tend to live longer than men. So that means that they have more time in the markets as well. And, they take their retirement funds very more seriously because women know that we tend to live longer than men do. Okay, so I said I wasn't going to go through all the myths, but I basically went through all of them. So if you want to see more, make sure you check out this article by Fidelity. I also have in my description box, I will list a form that I have where you can send me any of your inquiries. It'll look like this. It's a Google form. I'm just asking you to provide your email and your name and your reason for seeking help and your biggest financial concerns. And just let me know what you're interested in and what concerns you have when it comes to investing. Alrighty, so I will stop my screen share. And thanks so much for joining me today. Have a great one. Bye.